Good morning. My name is Kirsten Ross. I lead the Corporate Governance and ESG Advisory practice for Aon Australia. Firstly, I would like to acknowledge the Awabakal community of the Eora Nation, Australia's first people and traditional custodians of this land from which I come to you, and pay my respects to the elders, past, present and emerging. Thank you for joining this morning's session on ESG, a critical lever to long-term growth. Whilst the concept of ESG criteria has been in use by the investment community since the UN-backed Principles for Responsible Investment was launched in 2006, it is only now, 15 years later, that the pressure on organisations to meet environmental, social, and governance criteria is becoming more widespread. A host of stakeholders are increasingly attuned to how well or how poorly material ESG issues are being managed by companies. In this session, we will discuss how a company's management of ESG issues can influence access to capital, insurance, talent pipelines, and overall corporate resiliency. Joining me today are Meredith Jones, Aon's Global Head of ESG, and Pablo Baruti. Pablo is a Senior Investment Specialist at Stewart Investors. Previously, Pablo was the Head of Responsible Investment Asia Pacific at Colonial First State Global Asset Management, now First Sentier Investments. He's the founder of Altorium, a not-for-profit library and resource centre dedicated to supporting a sustainable financial system. He's also the former chair and a current director of the Responsible Investment Association of Australasia and was on the management committee of the Investor Group on Climate Change for 8 years. Meredith, can you please take us through an introduction to ESG and why it matters?
Sure. Thank you so much, Kirsten, for that introduction. And welcome to everyone to this session. We're delighted to be here to talk about what has become an increasingly important and topical issue for corporate issuers, asset managers, and asset owners. So I think the first thing that it's helpful to start out with is a framework of why we're having this conversation today about ESG and why ESG matters. When you think about the different stakeholders that are involved in ESG, each of them have a different dog in the hunt, as we say here in the South, when it comes to ESG. For companies, they obviously are more and more in tune with ESG as we get more and more data that ESG has a correlation with corporate financial performance. So the better a company performs from an ESG perspective, generally the better they perform in terms of revenues as well, and vice versa. So there's a lot of incentive for companies to really embrace ESG. But it's not just all about the bottom line. There's also a lot of other stakeholders in the conversation. Certainly, we have insurers that are increasingly interested in this area, whether it's on the investment side of their portfolio or whether it's on the underwriting side of their portfolio, where research has shown that lower ESG companies can lead to more payments on insured losses. The social license to operate is a term that's been coming more and more into vogue over the course of the past 2 years or so. And this indicates that society plays a role with ESG. They want to see that companies are doing business and delivering products that are not harming the environment and that are being delivered in a way that they feel like is contributing to future resiliency of people and planet. We also know that employees are increasingly attuned to ESG. I work on a number of engagements, whether it's in retirement or whether it's on the corporate side, where employees who are increasingly Gen Z and millennials and younger and want to have their values reflected in the companies that they work for, where they're really pushing their companies to embrace ESG, and doing so can actually lead to better talent acquisition and talent retention. We also know that regulatory bodies have been increasingly focused on ESG as well. At this point, there are more than 650 global voluntary and mandatory regulations that are focused around ESG and climate change. And we expect that number to continue to grow. Here in the United States, for example, the SEC is now contemplating a number of actions around corporate issuers as it relates to ESG and climate change transparency. And then finally, investors, a very important group for companies to be thinking about and for investors to be thinking about their own asset base. They're very focused on ESG because if ESG is a predictor of corporate outperformance and if ESG helps to boost resiliency, then clearly those are two things that investors are keenly interested in. And so, Pablo, since you're here representing the investor community, I thought it might be great to hear a little bit about how Stewart Investors is really approaching ESG and integrating it into what you're doing.
Thanks, Meredith, and great to be here. And I think it's probably worth just starting out to say that investors aren't a homogenous group. There are a lot of different views and approaches to investing in the market. For us, we started investing in Asia Pacific in 1988 and launched our first sustainable development focused fund in 2005. And fast forward 15, 16 years, and now all we run is sustainable development focused strategies, including global equities. Our investment philosophy and process is distinguished by being very bottom-up, so we're very interested in individual companies as opposed to taking views on sectors or market positioning and those types of things. We're very long-term in our view on company valuation, so we try to take a 10-year plus view on companies. We have no skill in trying to time markets, and we think that taking that long-term view is where we're going to benefit most for our clients. And when we think about investing and what a good investment is, we're primarily concerned with the quality of a company. So we look at quality through the franchise, the financials, and the management and stewardship of the company, and also the sustainability positioning of the company. So do they face headwinds from changing market dynamics around some of the issues that you described and we'll talk about today, or do they have tailwinds which will help support their businesses into the future? And that generally relates to their products and services, not just to the way they operate. So back to you.
Thanks. That's super helpful. And, I think it's really interesting to know, too, that one of the reasons asset managers have been very focused on this of late is that we do have evidence that focusing on ESG can actually lead to better investment performance as well. And also asset inflows are coming into asset management funds that are being focused around ESG and sustainability. In fact, more assets came into sustainable and ESG focused mutual funds in the first 4 months of the pandemic than had come in the entire previous year. So this is something that is really has a lot of momentum behind it, and we don't expect that to abate. So I guess that really begs the question, what are we talking about when we talk about ESG? And we've listed a number of factors here, but overall, there are 900 different ESG factors as defined by the Sustainability Accounting Standards Board, or SASB, which can seem like a number that is really incredibly hard to get your head around. The good news is that not all factors will affect each industry or even each company in the same way. So once you start to narrow this down into an industry viewpoint, then you're really only talking about 10 to 15 factors per industry. And it's really important to do that because one of the primary defining characteristics of ESG is that it is focused on material pre-financial factors that have the ability to impact corporate financial performance and resilience. So those are going to be the factors that are really going to be driving profits and losses for companies over both the short and the long term. And that's going to look different depending on what kind of company you're talking about. So the E, the S, and the G always apply to all companies, but the way that may look can be very, very different. For example, if you're talking about consumer types of manufacturing or consumer goods, then when you talk about environmental issues, you may be very focused on things like carbon footprint, the overall electricity usage, the emissions from the factories, the emissions in the supply chain, any type of wastewater or water dependencies. Those things are very traditional metrics of environmental issues. But if you look at a bank, for example, even though carbon footprint and those types of metrics are important, most banks don't have a particularly high dependence on fossil fuels, except maybe in scope 3 emissions, which is going to be more focused on travel and lending and things like that. So the way that environment impacts them is going to look a lot different. So think of it this way. If a bank is not doing a good job of vetting out its lending practices for home mortgages or commercial loans or within its investment portfolio, it can have a lot of exposure that could have a negative impact on corporate performance in the future. So, for example, if there's a lot of loans going out to industries that are in danger of being regulated out of existence, those companies are going to be less solvent and less able to pay back those loans. If a bank is making loans to consumers for residential mortgages, and those homes are in areas that are increasingly impacted by disasters due to climate change, the value of those homes is going to fall, which means the collateralization of those loans is going to go down, which introduces risk within the balance sheet. So both of those companies have environmental issues. They just look very different. Meanwhile, I think a lot of folks don't think of biotech or life sciences companies as having a particularly large environmental footprint, but that's really a company by company thing. There are some biotech companies out there that actually have higher carbon intensity than car manufacturers. So you can't always apply the same lens to every company. But frankly, when you start looking at biotech and life sciences, I think you get a little bit further away from environmental issues and more looking at how effective are the products, how safe are the products that they're making, how are they getting them through regulatory processes, and what's their marketing look like? Are they making good and reasonable claims? So again, don't get overwhelmed by the 900 different factors, but instead hone in on the things that really can have a positive or negative impact on your particular company. And one of the best ways to do that is by really looking at this from a stakeholder view. So ESG is something where you've got really primarily 6 major stakeholders. And if you think about how your company interacts with each of those stakeholder groups, you're likely to be able to suss out what's really material, what has the potential to have an impact on your company's bottom line by looking at that. There are a number of frameworks that have attempted to kind of get this into a manageable process, but there's still a lot of disparity among those frameworks, and you can see quite a bit of movement between ESG scores that come from one provider or another provider, and even the global frameworks that exist for this. For example, the Global Reporting Initiative, the Sustainability Accounting Standards Board, the Task Force for Climate-Related Financial Disclosure, the Carbon Disclosure Project, all of those have different inputs and outputs as of right now, although there are some movements to try to make them better. But in terms of the different stakeholders here, Pablo, I know that that there are a lot of groups that you look at when you're looking at these at companies to evaluate the quality of those companies, as you mentioned. So can you talk a little bit about how this might filter into your decision-making process?
Absolutely. And I think when you're starting out investing in Asia-Pacific equities, particularly as far back as what we were, the way that companies are managing their relationships with their employees, with the communities where they operate, the stewardship that they show over their environmental footprint and management practices are really important insights into the quality of the management of that organization, whether they're actually got their finger on the pulse of emerging risks and issues and looking to the long term to deliver value for the business, but also for those other stakeholders. And so for us, those types of considerations have always been a really important way to understand the quality of the management team, but it also extends into other areas as well. So we look at, when we think about the quality of financials, we look at things which are a bit kind of counter to what you'd expect in financial theory. Like we look at the taxes that companies pay, and we want companies to be paying a reasonable amount of tax, because if we feel that the company is taking shortcuts in the amount of tax that it's paying, that is not sustainable, and that those revenues are kind of illusionary and in the future are at risk. And so we don't necessarily see it as a positive thing to have unrealistically low or unreasonably low tax rates. And we see now with the OECD coming out with agreed minimums for all of those markets, that some of those issues are certainly coming home to roost. Similarly, in terms of the franchise of a company, clearly, particularly for any consumer-facing companies, its reputation is critical to its long-term success. And we've seen so many instances over times where poor management of these types of issues impact on a customer's view of the company, and therefore whether they're willing to continue to do business with it. And so these issues have direct impacts, but they also have impacts on a whole host of other relationships that we're very conscious of when we're considering the quality of companies.
And I think those are some really great points to consider. I think one of the key factors around ESG is just that how interconnected things become. Obviously on the regulatory side, for example, regulatory bodies are trying to control macroeconomic risks, but those are going to have microeconomic impacts on the companies that are being asked to do these types of disclosures and the asset managers that are investing in these companies. They also, of course, have to take into consideration, as I mentioned, the various constituent groups. You think about employee safety for a moment, and it's very easy to see how that can become a material pre-financial issue if you've got an environment that really can be dangerous for employees. So, for example, if you've got a bad track record of employee safety, you can start to see that cascade through other stakeholders. So from an employee standpoint, it can be more, you're going to have direct costs related to employee accidents. B, you could potentially have litigation that's associated with that. C, you could have regulatory fines that are associated with your accident-prone workplace. D, you can end up with consumers that don't want to do business with you because if you keep making the news about how your workforce is having all these accidents, that's a problem, which will translate into loss of a social license to operate. That not only will your customers decide they don't necessarily want to do business with you, but your prospects may not want to do business with you as well. You can also have issues with product degradation as you have to hire workers more frequently and train those workers, and the overall productivity goes down and the cost of that talent goes up. So it's really easy to see how that can cascade through all of these stakeholders. And by doing that, you can really get a good sense of exactly what's going to impact you from an ESG standpoint. But of course, probably one of the easiest lines to draw at this point is ESG and the cost of capital. So we've definitely started to see a number of instances where ESG characteristics can impact the cost of capital, both for the better and for the worse. So one of the things I think it's helpful to do is to think about how the credit rating agencies are starting to evaluate companies based on ESG. So for example, here we have Costco's S&P credit rating, and you can see that there are a number of factors involved in the Costco credit rating now that relate to ESG, everything from supply chain to recycling, all the things that are going to help to maintain that stakeholder interest and resiliency in the company. But Pablo, I think you guys may be invested or have been invested in Costco, so why don't you talk through how you have evaluated Costco from an ESG perspective?
Sure, we are investors in Costco, and I think one of the things that distinguishes Costco as a company is that it may not rate well on some ESG scores by external providers, so that historically their disclosure hasn't been at the leading edge and those types of things. But for us, we look at Costco and look at their culture, at their long-termism, at the customer focus that they have, and their business model is very unique with the membership model that they have and the fixed margins that they apply. So they're genuinely sharing the benefits of their scale with their customers each and every day, and has developed a huge amount of loyalty through that. And they also aren't a kind of a boastful organization in terms of their marketing, and they have some excellent programs in terms of their Kirkland private label brands, particularly around coffee. We did research recently on some of the sustainable sourcing practices they were doing with communities in Africa around the sourcing of their coffee. And they clearly talk about these things, but it's not necessarily one of those headline things that you might see with some other companies. And so they're relatively modest. And so what we find really attractive about Costco is that they have a history of doing things. When they do things, they do them really well. They're not sort of fazed by short-termism of the market, particularly in things like how fast they're willing to grow. They want to do things properly and in a deliberate way. And when they turn their minds to something, they get things done really quickly. And recently they've hired a head of sustainability. They've been doing a lot of extra work on climate. And so we can see Costco as being a company with a fantastic culture that has a really a kind of a sharing of benefits style business model, but that also is ready to really improve dramatically in terms of sustainability and ESG. So we find it really attractive.
And I think that's great to point out, particularly the disparity of ESG scores and not trying to manage to those scoring systems. All too often, I think we get approached by our corporate clients saying, hey, one of our board members got this score and it says that we're not great on ESG, or hey, we don't really need to talk to you about ESG because look, we have this score and it's really great. Unfortunately, as I mentioned in passing earlier, the disparity among the roughly 20 or so scoring systems out there is enormous, and that's due to a number of different things. Number one, remember when I talked about materiality? Well, materiality is going to be weighted differently from ESG ratings group to ESG ratings group. And so they may be weighting something either differently or more heavily than another, and that can significantly impact your score. Where they get information from varies greatly. So there are some of the ratings providers who only look at public disclosures. As Pablo mentioned, Costco hadn't been much for public disclosures on this, and they only go with official disclosures, so 10Ks, 10Qs, 20Fs, that type of thing. And not everybody has, and not everyone has started to disclose in that fashion yet. And of course, a lot of people rely on things like sustainability reports, which may not even be considered in that rating assignment. They also update their ratings at different times. Some things can be incredibly hard to quantify. So, you can say, for example, this is a percentage of diversity that we have on the board, and that boils down to a number. But you can't say we have 6 cybersecurities. So that's more of a qualitative decision that those companies have to make. And so what you end up with at the end of the day is that I pulled, for example, 4 different scores from 4 different ratings providers for one company recently. One of those providers had given that company nearly the highest score they could give, 92 out of 100. One of those ratings providers had given the lowest score that they possibly could, a triple C, and then the other 2 were in the middle, 48 to 52. And so as a result of that, it's really important to do the hard work and the homework on this so that you can demonstrate to the different market participants and those different stakeholders that we talked about that you're doing the right things, even if a particular rating doesn't come out to your advantage. Trying to manage to those ratings can really be like playing a game of whack-a-mole. But
yeah,
at the end of the day,
and also just to add to that, sorry, I just had to jump in on the ratings aspect. Is that being fixated on the rating is a recipe for disaster, and we would say that as a bottom-up investor, that really you need to focus on your own company, where the impacts are, who your stakeholders are, and what they're interested in, and let the ratings take care of themselves. I think looking at those types of benchmarks and seeing that as success will only lead you to focus on too many things or the wrong things.
At the same time, though, I think it's really important that you don't want to end up near the bottom of everyone's. If you are coalescing around the same scores across a lot of different data providers, that's probably an indication that maybe you want to go and do a little bit of homework, because at the end of the day, as I mentioned, ESG does have an impact on overall cost of capital. So if you look at these, you can see that higher ESG companies have better cost of capital, better cost of equity, and better cost of debt. And we're even seeing instruments that are getting introduced that we'll talk about in just a moment that are using ESG to help provide very specific kinds of financing to companies. And it doesn't really matter where you look. If you look across any different type of sector, there really is an ESG risk premium when it comes to access to capital. And so, again, while you can't manage to any one scoring regime, I do think that sometimes it's helpful to look at it kind of like analyst research, that you can maybe get some hints about things that you need to that you should be looking into. But then again, as Pablo mentioned, you still have to do the homework. So again, I think there are some really exciting new financing options out there too. Some of them are not so new, I guess. Green bonds obviously have been around for quite some time, but we've seen a real explosion in those in terms of growth of the marketplace. In fact, I think at this point we're on track to have about a $500 billion year associated with green bonds. Social bonds had their best year ever in 2020, probably not surprising considering that there were so many social issues to focus on. When you look at those two kinds of bonds, they're really project linked. So you have to make sure that you are using the proceeds from those bonds in order to work on a specific project that is either going to have a green outcome or a social outcome. If you've got something that's a little bit more mixed between green and social, you can look at sustainable bonds, which are going to have both green outcomes and sustainability and social outcomes. But in recent years, we've started to see the emergence of ESG KPI-linked bonds, and I find these really particularly interesting in many ways for a lot of companies that are out there, because they're not project-linked. Instead, it is a bond, and in some cases, just a credit facility, depending on what type of entity you're dealing with. They're going to be linked to gains around specific ESG key performance indicators that are pre-agreed before the issuance of the bond. And assuming that you hit those, then you pay a preferential rate for the bond that will be lower. And if you don't hit them, and it is a simple yes or no equation at the end, then you pay a penalty for not hitting them. So in terms of being able to lower the cost of financing and still make progress on ESG, with the option of not having to link to a specific project, I think that's a really interesting way for companies to move forward. Again, as I mentioned, when we start looking at the growth of green bond issuance, this is something that's really taken off in recent years. It's something that we expect to see grow exponentially, kind of like the assets that are coming into ESG and sustainable themed funds as well. So again, I think this is something that has been maybe not in the mainstream until too recently, but something that is definitely going to continue to make itself known. And we definitely have a lot more clients that are looking at ways to obtain ESG and KPI and green bonds, and also looking at ways that they can potentially de-risk those situations as well. So with that, I want to quickly hand it over to Kirsten. I know that you've got some great examples around Australian company Coles. So can you walk us through that case study?
Thank you very much, Meredith. Yeah, so just calling out in relation to those ESG KPI-linked bonds. In August this year, we saw Coles Group announce in a press release that it had refinanced $1.3 billion of existing commitments into this type of facility. Coles had announced it would be incentivized through margin adjustments to achieve sustainability targets linked to the following metrics. Those reduce Scope 1 and 2 CO2 emissions, increase total waste diverted from landfill, and increase percentage of women in leadership. And whilst it hasn't provided the exact details of the metrics to be achieved for the offsetting basis point reduction, the fact that Coles has made that direct link between sustainable performance and cost of capital and used it as an investor relations exercise to engage with all its stakeholders, stating that it believes that sustainable businesses are better businesses and our sustainably linked loans reflect our commitment to working with all stakeholders to make positive change, is definitely an indication of where market practice is heading here in Australia.
Thank you, Kirsten. And of course, it's not just about the cost of capital. And of course, it's not just about the increased potential for better corporate performance, but there are other issues that ESG is increasingly impacting as well. And one of them is both the access and the cost of insurance. And of course, that's a subject that we hold near and dear to us here at Aon. And one of the reasons that we're starting to see this movement is that there are the ratings agencies for insurers. So this, for example, is information from AM Best, which rates insurers based on their credit quality. They are now evaluating the insurers based on ESG. And so you can see here that even though there weren't a whole lot of ratings agent actions taken based on ESG in the most recent year, only about 13% were impacted, and perhaps predictably, a lot of those were property and casualty, because the physical risk side of insurance is something that I think insurers have long been attuned to, obviously, catastrophic weather and those types of events. It's something that we definitely expect to see more and more going forward. I've recently seen statistics that show that even in an orderly transition, that insurers, if they don't do a good job of managing the ESG and climate change risk in their portfolio, could end up with some pretty serious asset liability mismatches within their portfolio. And also, as I had mentioned, I think there is increasingly a lot more evidence that shows that ESG does have an impact on the payment of insured losses. So, for example, if you've got workplace issues where workplace safety is a risk, then obviously that can lead to payment of a higher payment of losses. ESG has, again, we've discussed interaction with regulatory bodies, so it can increase the amount of fine payments. It can also impact things like D&O insurance. There's all types of ways that ESG intersects with the underwriting of insurers, and that's something that we're increasingly focused on at Aon, is how do we help to make cosmos out of the chaos there, and begin to showcase, what are the linkages exactly between ESG and the underwriting process, and how can we help to quantify the companies that are managing their ESG risk better and maybe would qualify for more preferential rates or for maintenance of capacity versus maybe companies that don't. So those are things that we expect to see coming online more and more frequently over the course of the next 12 to 18 months, and we'll keep you posted on how that's developing. So Kirsten, I'll turn it back over to you for the rest of our conversation.
Thank you very much, Meredith. And that's super fascinating about how ESG is impacting access to insurance now. And I'm sure, as you mentioned, there's a lot more to come in this space over the next 12 to 18 months. So we'd like to enter into a panel discussion today, and I'm sure that we could talk all day on a number of the 900 factors, but we'd like to briefly focus on two, time allowing, and the first being climate change. So with the Nobel Prize for Physics being recently awarded to two physicists who I think it was over 4 decades ago now set up the scientific basis, which we've actually has been proven now to show that climate change has moved from being an ethical and environmental issue to one that actually is one that's very real. And definitely the dialogue around this in the media and has moved in the last 12 to 18 months to show that it is one that actually presents one of significant financial risks and opportunities for organisations. Approaching COP26, there are so many different aspects that we could talk about, from physical and transition risk to disclosures, mitigation versus adaptation. And given the number of natural catastrophes we've seen across Europe and the US in the last 6 months, let's briefly explore physical risk. So from an investor perspective, how do you measure and assess this, Pablo? I'm sure that the listeners would be very interested to hear. And where do you start?
Thanks for that question, because it's a really difficult one. And I'd hazard to say that I don't know that anyone's particularly good at this, perhaps other than the big insurance companies, and even the nature of catastrophes is changing so quickly that perhaps it's hard to keep up with. I think there's probably some considerations that anyone can do, though, in terms of these issues, because on one hand, it's easy to look at a company that's in a single location and understand potential changes that might impact on their own asset base if it's in one place. Whereas when you start looking at multinational companies with multiple locations, clearly different set of challenges, and you're really looking for the management infrastructure and the management understanding rather than looking to assess every single asset individually yourself as an external investor, to understand what are the steps that they're taking to assess their exposure, to put in place mitigation and so on. But it really doesn't end there. And in fact, some of the most important impacts happen outside the company's gates, because we've seen, whether it's water issues in Taiwan that's curtailing semiconductor production for companies like TSMC, or whether it's coffee shortages which are impacting on the price of coffee around the world. And I mentioned earlier Costco's program in terms of direct supply from Africa and trying to build resilience into farmers' practices there so that they can be more climate resilient. In all these kinds of supply chain aspects, you're going to see these issues come through, and it's really important for companies to think about that. But lastly, I just want to also point to products and services, because clearly if you're selling ice creams and it's getting warmer, then that's probably a good thing. But if you're selling jumpers and cardigans, then maybe not so much. And so retailers are also having to think about their inventory, their stock, and they've got very sophisticated practices already in place. But I think there are going to be some natural and growing headwinds in relation to the physical impacts. And so I think it's important to get really good advice. It's important to be able to demonstrate that you're thinking across the value chain, not just your own asset base. And it's important to show that you have a plan, because nobody's perfect in this area. We're all learning. And I think companies that sometimes put themselves out as not having all the answers or not being concerned are two sides of a coin, neither of which is helpful. You actually want companies to engage in a dialogue around it and show that they're developing their capacity and their processes to deal with these issues.
Thank you very much for those comments. So definitely, I think it comes down to how they communicate where they're at on the journey in relation to that one with their stakeholders. It's the takeaway I'd have from that one. In relation, if we look at another aspect within climate change, which is highly relevant for the Australian economy, mitigation versus adaptation. Meredith, what do you see the role of insurers in the transition to a green economy?
Well, that's a great question. And, I think when you look at mitigation, which of course is the reduction of carbon, and when you look at adaptation, which of course is our resiliency to climate change related and weather related disasters, insurance really has a big role to play on both of those. Obviously, because insurance is so vital to the global economy and to the capital markets, you can't invest in what you can't insure, for example. Then it's really, I think, incumbent on insurers to start thinking through how we can be participants in the transition to a greener economy through our work with clients, and whether that comes through and how things are underwritten, or whether it comes through on the investing side of the portfolio, where I see and work with a number of clients who are working to decarbonize on the investment side. Those are both really, really important things and roles that insurers have to play. On the adaptation side, obviously, when you start looking at insurance-linked securities and cat bonds and other aspects, I think there's been a lot of research, including papers from the World Bank, that show that insurance is really necessary for an inclusive transition to a green economy. So, in terms of being able to work to insure natural resources, whether it's carbon sinks, mangroves, forests, things like that, whether it's working to ensure the IP that's going to be associated with some of the technological breakthroughs that are going to come from through the transition to a greener economy. Really, there's no place that I look at this point where insurance doesn't play a role. And I say that not just because I work at Aon, but because I think it is just a simple fact.
Thank you very much for those comments, Meredith. So if you're interested, I'm sure we could actually have hosted this whole session. Sorry, would you like to make a comment, Pablo?
If you don't mind, I just wanted to chat a little bit about insurance, because I agree with what Meredith has said. And I'd also just suggest that I think the other role that insurance plays is very much at a local level. I mean, obviously, insurance companies, the nature of their business is to aggregate risk. But what I think the kind of general position historically was, well, we can increase premiums or stop insuring certain areas to deal with the changing climate, which is effectively saying that we're going to shrink our business and reduce the pool. And so that's not really a sustainable option. Hoping for better weather in the future is not a sustainable option. But we have seen examples of insurance companies that have worked with communities who have had catastrophes and government and the local businesses in that area to try and build a more resilient community, which then makes them more insurable as well. And so I think the role of the way that insurance companies engage with government, with local communities to try and build resilience so that they stay insurable at an affordable rate is really important, and a really fantastic contribution that insurance companies can make.
Thank you very much for those comments. And I think definitely, it's definitely clear that there is that the role is quite critical in the sustainability of the economy. So now, as I mentioned, we could talk all day we could have talked all day just on this topic. But if you are interested, please join our session tomorrow on climate risk modelling at 11 a.m. with Peter Cheeseman, Head of APAC Analytics, and Stephen Bowen, a Managing Director of Catastrophe Insights Impact Forecasting. Now, I think we have enough time to turn to our second topic for panel discussion, to diversity and inclusion. So we might just start with yourself, Meredith. Can you please explain why this is important for business?
Yes, and in fact, I'd love to, because I think a lot of times people approach diversity, equity, and inclusion as it being the right thing to do, and from a moral standpoint. And while I think that is undeniable, I think there's also a ton of research at this point that shows that more diverse organizations tend to be more profitable because they have better problem solving, they have more perspectives they can bring to bear. We've seen, for example, that companies that have higher percentages of women on the boards tend to outperform. We've seen evidence that shows that diverse groups tend to have better decision making. So I think it is undeniable at this point that diversity, equity, and inclusion is a business imperative and not just something that's driven by a sense of right or wrong. And so as a result, I think that's one of the reasons that we see so many investors focused on this at this point in time, because the linkages between diversity and performance and resilience are really just incredibly strong at this point.
So Pablo, on that, how do you actually include that in the investment process and actually make those assessments?
We think about diversity a lot and try to get data, and on gender, it's a bit more straightforward than in other aspects of diversity. But one of the things which is critically important is inclusion, which ought to really come first, because there's not much point having a lot of diversity if those views aren't included. And that's really a question of culture, of management, the way that they bring people together. So we spend a lot of time really thinking about the culture of organizations, thinking about the management of organizations. We try to look for humility and openness in those discussions, and in our discussions with we're fortunate to be able to talk to a lot of senior management, CEO, CFO levels, director levels in organizations. They're the kinds of hallmarks that really tell us a lot about whether the growth in diversity is actually also being included. I think, while I agree with Meredith that there's clear business cases and drivers for it, I think we have to also recognise the equity issue that sits at the heart of it. I think the World Economic Forum earlier this year, in its diversity report, said at the rate that we're going, it's going to take something like 160 years for gender diversity, gender equality to be reached, and on pay parity for genders, it's over 200 years at current rates. And so I think unless you're actually coming at it from the position that this is the right thing to do, and that type of long-term time frame to fix these issues is not acceptable, then we're not going to get as far as we need to. So I think companies really need to treat this as what sort of organizations do they want to be, how do they want to present themselves to the world, what sort of corporate citizens do they want to be, and clearly not dealing with those issues can't be viewed as acceptable, I don't think.
Thank you very much for those comments. And yeah, I will just reiterate, I know here in Australia we've had, it's been entrenched in legislation since the 1970s, that equal pay for equal work, but there's still, I think that report showed recently that there's still a gap of a female in the same role as a male will have to work an extra 61 days to achieve the same pay. So definitely, I think it's definitely top of mind for employees, and it's still a real business issue. So just turning to in closing, that what gets measured gets managed. We spoke before on how their portfolio companies are actually managing their ESG issues, in terms of how that's actually coming through then, because of that correlation with overall performance. And what we would say is, in our experience, that all companies are at different levels of where they are on their journey, from identifying which topics are material, integrating it holistically into their business strategy, and holding executives to account through their remuneration And as we mentioned before, the note that this is, or the perception out there that this is only for publicly listed companies is well and truly outdated. We saw an announcement earlier this month that a group of investors led by CalPERS and Carlyle Group, which oversee more than $4 trillion worth of assets, have agreed to use standardised data on environmental and social and governance performance going forward to understand what progress their portfolio companies are making on this and how that actually relates to the financial performance of their managers. And as we know, for fund managers, what gets measured gets managed, which brings us to a local case study here. So earlier this year, we partnered with a privately owned business to help shape better decisions on their ESG journey. We were engaged by their board that had a number of representative directors from institutional investors to review their executive incentive design. As part of this, we explored with them what were the strategic focus areas for their business over the next 3 to 5 years. And as part of this, they had identified that they had implemented a newly developed ESG strategy and that holding their executives to account on the delivery of key milestones to ensure achievement of 2030 targets were met, sat alongside the achievement of financial outcomes from their perspective. This is actually consistent with a global study released earlier this year that showed Australia leads the way in companies incorporating ESG metrics into their CEO remuneration, with 81% of the ASX 100 having at least one ESG metric in their incentive opportunity. The takeaway here is that, as you can see, it's an airport, is ESG is really relevant for all companies across all industries, and it's not a matter of if an ESG metric will be incorporated to executive incentive design, but when. We all know that a company's approach on ESG is top of mind for directors, with increasing litigation from shareholders on climate and other funded class actions resulting in D&O premiums escalating to all-time highs. So the one thing that we'd ask you is, where is your company at on the ESG maturity curve? And if we were to ask directors this question, would their answer be the same? And in closing today, what's the top piece of advice you would offer to listeners? Pablo. Pablo, we've just got you on mute at the moment.
Sorry. I think what we've learned from today is don't just tick boxes. It needs to be core to your business. You need to think about it strategically. Talk to your stakeholders, understand your stakeholders, because they're the ones that can help determine what's going to be most important. And don't think of this simply as a wrapper or a marketing tool. This really has to be something which gets taken into the boardroom at very senior levels within the organisation, because people are very quickly onto inauthentic attempts at marketing their company sustainability attributes. Make it real.
Thank you. Meredith.
Well, Pablo made a great point. I mean, this definitely has to be something that gets worked into your DNA. But I think a lot of times when I talk to companies out there, or asset managers, or anybody who's in that stakeholder stack, what I find is that people are really daunted by the amount of work. I talk about ESG and climate change like a Russian doll. You seem to take the top off and there's another doll and another doll, another doll. And what I can tell you is, having worked with investors and with all the different stakeholders, no one's expecting you to have it all figured out from the get-go. And so the most important advice that I can give is the advice that my grandmother gave me one time, which is start somewhere and keep going. And make sure that you communicate what you're going to be looking at in the future, so that folks have a sense of direction of travel. This is really more about getting somewhere eventually than trying to put in kind of quick fix. Oh, hey, we've got a policy on this, we've got a policy on that. People really want to see that there are measurable and achievable targets and the progress that you're making towards them. So get started, and eventually you'll get there.
Thank you very much for those comments, and thank you very much for joining our discussion today. You've both provided some excellent practical examples of where companies can start on this journey if they haven't already. So now, as we head into a short break, there's a chance to find out more about the key areas of client need Aon has identified. In the following video, we look at how businesses need to find new sources of funding solutions to accelerate growth, and how it's never been more important to take the most of data and analytics to make better decisions around accessing new forms of capital. In the second video, we look at the fundamental shift in where, when, and how work gets done, and the vital decisions employers must make to enable an agile and high-performing workforce. Businesses are facing mounting pressure from all sides, and whether it's the rise of remote working, an increased focus on staff wellbeing, or the expansion of the gig economy. After the break, 3 of Australia's leading CEOs will join us for a panel discussion on creating resilience through meaningful health and wellbeing programs. Please join us for the Resilient Workforce session at 12 p.m. Thank you very much.
Capital is the lifeblood of business and society, constantly evolving in sophistication, driven by new technology and new types of assets, creating ever more risk and opportunity. For organizations of all sizes, and even for many countries, capital has always been critical to sustainable growth. But in the face of increasing risk and complexity, we all need to be more creative and effective in our approach. Aon helps clients understand and access new forms of capital and make the decisions that help them innovate with confidence. Decisions that match a company's risk with the right capital structure. Sourcing new capital to help governments fund emergency recovery. Formulating the true value of every asset, both physical and intangible, and measures to protect them all against everyday threats and catastrophic events on the horizon. From aligning assets with enterprise strategy to advising on new sources of capital, from helping clients use analytics to identify efficiencies, to unlocking the tangible value of intangible assets. Aon's expertise, global understanding and advanced analytics ensure that every client is better informed and better advised so that they can make better decisions. Aon is in the business of better decisions. Over the last decade, the world of work has changed dramatically. For individuals and the organizations they serve, a fundamental shift in where, how, and when work gets done. It's a change that can cause a disconnect between a company and its employees. But a partnership with Aon can help by making decisions that create a more flexible, engaged, and resilient workforce. Decisions on how to manage the evolving structure of work, solutions to achieve a healthier and more inclusive team, choosing new reward structures that aim to maximize profit and engagement, providing ways for individuals to plan their own futures. From showing how to stay ahead as work evolves, to helping individuals and organizations realize their shared ambitions, from boosting performance through employee health and well-being programs, to solutions that provide for a secure retirement, Aon's experience and expertise, global understanding, and advanced analytics ensure that every client is better informed and better advised so that they can make better decisions. Whatever the next decade brings, Aon is in the business of better decisions.